Good morning, everybody. I trust that you are well. You would notice that the faces on screen are not faces that you're familiar with. The reason being, this is the first risk video that I'm doing in 23 years. So I'd just like to welcome Stephen van Niekerk and Cashandra Britz from Momentum. Stephen has been with Momentum for 20 years. He's a qualified actuary and he's the head of Momentum Myriad. In other words, Momentum Long-Term Insurance. Cashandra has been with Momentum for 28 years, and she is my Momentum business consultant. So welcome, guys, and thank you very much for your time. I think the purpose of this video is to put long-term insurance in perspective. And as you know, I don't like to repeat myself, hence I'm videoing it. And it's also much better for you to hear it from the horse's mouth, the people that actually design these products, than to get secondary information from me. So before we start, I would like you to get a piece of pen and paper together, and I would like you to do the following for me. My screen is not shared yet, just give me 1 second. On the video it will. Cashandra, Stephen, you can't see this, but on the video it will be fine. So just tell me what life cover amount do you currently have in place, and tell me what income protection do you currently have in place. That is now, should something happen to you to replace your monthly income, what is the cover amount? Tell me what your disability cover amount is and what your critical illness cover is that you currently have in place. If you do not know the answers to these questions offhand, your finger is not on the pulse. And that is a reason to be concerned. You should know these amounts and what you're currently paying for it, as you know how much a bread costs, as you know how much it costs to fill your vehicle with a tank of petrol. So today we're only going to talk about life cover. In further videos, we'll cover income protection, we'll cover disability cover, we'll cover critical illness in more details. We'll also talk about what life returns is and how you can benefit from it. And then for a select audience, I will make a video regarding key man's insurance, buy and sell agreements, and employee benefits. So hopefully you've now completed the cover amounts that you have and what you're currently paying for it. And then I also want you to take a flyer and jot down figures. What do you think this cover is going to cost you when you reach the age of 50, 55, 60, and 65? The reason I'm mentioning this is it is important to understand that what you are currently paying is not necessarily going to escalate by inflation. It's going to depend on what premium pattern you're on and at what pace that is going to escalate as you get older. And the reason I stop this at age 65 is one usually only takes life cover up until retirement age. The methodology behind that is, should something happen to you today, whatever cover you have get paid out to your spouse invests that money, and that money is used to replace the income that you would have earned had you been alive up until retirement. So out of that money, you need to pay your monthly living expenditure, and you also need to save for retirement. But without going into any further detail, I would like to hand over to Stephen to take us through a couple of pointers regarding life cover. So over to you, Stephen.
Thanks, Jan, and hello to everybody, and thanks for this opportunity. And as Johan's mentioned, I mean, life insurance is a generic term, and often, it's referred to products that you save for retirement or protect in the event of, you passing away or having a critical illness or disability. And for today, we're just talking about, the products that cover you in the event of death, and therefore sort of life insurance cover. Now, in essence, it really is if there's a financial impact to the loved ones that you leave behind after your death, then you really need life insurance cover. And traditionally, it's sort of the approach followed is sort of at the bottom right of the slide. It really is about replacing your income. So you have a family or loved ones that depend on your income. So in the event of your death, you want that income to be replaced. Often that income is used to repay debt and education, so see that almost in the same box. But often it's forgotten that there are other expenses that need cover, and often other costs need cover, and insurance that is needed for a wider range than just replacing your income. And you'll see sort of on the left-hand side there, funeral expenses themselves. There's a need after your death to cover funeral expenses. There's access to cash needs. Sometimes you typically nominate the beneficiary for your life cover, but what could happen is money could be tied up in an estate, for example, if a beneficiary was not nominated, and there's an immediate need for cash, and therefore it's important to consider that in the construct when you chat to your financial advisor about the different benefits. As Johan mentioned, almost for separate audiences in a estate duty, often payable on the death of the second life insured, there's estate duty payable, and there are products that can specifically provide cash to cover those taxes, and also complements a financial plan, and something that definitely must be considered. And then you can even see, you might prefer to leave a legacy. You might want to leave a legacy to or benefit to the SPCA, for example. And those are the type of things that can also be used, or life insurance can be used for. And then business assurance, you might be in a business with a partner, and you might have an agreement in place that if this partner passes away, you actually buy his share of the business. And with business assurance, you can take cover out that gives you the cash to pay or buy out that part of the business. So very much used in business assurance. Other concepts like key person insurance or contingent liability in the event of a debt for a business also being settled on your death. So as you can see, it's not just the basic income replacement. Life cover is needed for a range of other things, and definitely worth speaking to someone like Johan about this. Typically, and Johan will show that a little bit later as he calculates a typical lump sum amount that is needed. Often life cover is put in place to provide a lump sum payout, and makes a lot of sense. You want to cover some of these immediate expenses. You might want to settle some of the debt and free your dependents from that debt. As mentioned, you might want to leave a bit of a legacy or have a business buyout enabled by that amount. So typically, it is provided by a lump sum, and then that lump sum is used then to sort of invest often with the help of an advisor again for future income. What's not well known is that you can actually complement this lump sum payout product with something that provides a regular payout, and we see that often used in a financial plan. For example, it could be because of practical reasons, but money could be wound up in an estate and could take a little bit of time to wind up. Also could just be a difficult time for the family, and you don't want to make those big decisions about a lump sum amount and how you want to invest it. So having a product that pays you a regular income, almost as if that dependent never passed away, it could be for 6 months, 12 months, or 24 months, really sort of buys time, covers those monthly expenses, and really provides some much needed cash flow. So speak to an advisor. It's a great product, and we often see that as combination, almost in the same way as in later videos you might see lump sum disability in combination with income protection. I guess, moving a couple of other points. It's obvious that these needs change over time, and a youngster with no dependents often need very little life cover, but as you grow older and you have dependents or you have business debt, those things will change. So it's not something that you do once in your life. It is important that you do it early in your life, because as you get older, you might get unhealthy or unwell, and might be difficult for you to buy insurance. So it's often an asset that you want to almost secure as you are quite young. And that links maybe to the second point, that often employees think that they're part of a group scheme, and therefore they don't need to complement or supplement that with individual cover, which is not always true. You typically could be part of a group scheme with your employer and have access to group life cover, but there are some things to look out for. Number one, they'll typically give you a multiple of your salary, so it's not calculated with a lot of science behind it. It's often a multiple of your salary, so you need to go do your own sums or speak to an advisor to see if it's enough for you. Often the price is one that's calculated by looking at the whole group. So if you're a youngster, you're paying the same premium for every rand of cover as an old person. So there's a subsidized rate in there, and you could actually get a better deal. And then lastly, typically when you leave the employer or when you retire, that group cover ends. Often you'll get what is called a continuation option, where you can then purchase an individual product at that point in time without any medical underwriting or tests. But bear in mind then you're now 65 years old, and because you're older, that insurance will be more expensive. So if you leave that too late, that'll also cost you. And with life cover, it's perhaps not a big thing, but with disability and critical illness cover, often the cover provided in individual wrappers are more comprehensive because there's more appetite to buy a better product, whereas in the group market, it's often a big focus on affordability and hence the comprehensiveness of the products, often a little bit lower. And then the topic that is often comes up, Jan, is insurable interest. So how much can you insure yourself for? And we often get the perception, clients will say, I can afford the cover, therefore you should give it to me. But we only insure you for what gap you will leave, or what indemnify you against the loss. For obvious reasons, if you can insure yourself for any amount there, you might have a reason to end your own life, or you might know about something that we don't know about. So it's good financial practice for us to make sure that we only give you what your insurable interest is, and you'll show in your calculations thereafter what that sort of amount typically would be. But that's normally not a problem when businesses get very big and there's big deals in place. We often give cover for amounts above 100 million, 200 million, and then there's quite an in-depth exercise in understanding the financials of a company to make sure that the value of a company, for example, is accurately reflected in the insurance.
Sorry, Stephen, if we can just maybe go back one slide on
please.
On the insurable interest also. It's not necessarily just the financial underwriting, but also who can insure whose lives. Can I take cover on my parents' life? Can my kids take cover on my life? So that is also something that needs to be discussed, because not everybody can insure anybody. There has to be an insurable interest, a loss in the effect of that person dying.
Yeah, that's a very good point. And actually, from an interesting perspective, is that's normally determined at the start of a contract. After the contract is actually in place, it's then quite easy to change or cede a policy or change beneficiaries, and that's often not regulated, which makes it quite flexible. After you have this cover in place, it's often easy for you to adapt or use that for a different need. Once again, speaking back to a point of get the insurance when you're young and healthy, and typically get it at the cheapest rate possible. And that maybe leads to the next point. Is when you buy life insurance cover, it's a little bit different from buying cover for your car, where I guess, probably you'll be safer. As you get older, you're probably a safer driver, up to a point where it becomes more risky later on in life, where life insurance is different. And you can see from the graph there, sort of the probability of dying really accelerating after age 45. And that means that we as insurance companies provide you with a cover that we need to price based on this probability curve. And that means in its purest form, we could say to you, as you get older, you need to pay more and more for the rand of cover that you have in place, which is obviously not ideal, because you might need that cover late in your life for you to experience that significant increase. And if you look at the next slide, I've tried to simplify that red graph as really see it as a risk curve or the chance of passing away. So insurance companies give you the chance to pay for your cover in different ways. The picture on the left-hand side is what is typically called a level premium policy. So you will pay a level premium throughout the lifetime of your contract for a set amount of cover, even though the risk of you claiming goes up over time. So you can see in the picture, you're almost paying too much in the beginning, but you then subsidize by paying less over time. And on the right-hand side, insurance providers then give you the opportunity to flex in between and give, for example, a compulsory growth where your premium will grow every year with a fixed rate. And that really gives you a chance to cash in with a slightly lower premium, but it increases over time. So very important for you to not just focus on the initial premium, but to understand how your premiums will go up over time. Because that's really, you're buying a long-term insurance product, not something that is just for next year or the year thereafter. And that really sort of gives you a bit of a sense of how premium patterns work. And then Jan, sort of just a couple of last thoughts on it is I guess there's often false perceptions around insurance companies and what they provide. I think we paid more than 5 billion rand out in claims last year. We very, very seldom that there's any repudiation on life insurance cover. I think typically our repudiation rate is below 0.2%. And most often, 80% of our repudiations typically would be because clients, unfortunately, don't disclose all their full medical information to us upfront. And then in some cases at claim stage, we then repudiate that claim, but that is very much in the minority. The other repudiations typically because of suicide, which is the only exclusion on life insurance cover. So my tip to you, and as a client who work with you on, make sure you disclose all the medical information, be thorough and upfront with this information. You want to make sure that there's certainty in this product that you take out. You need to also then just check contractually what you need to tell your insurer on an ongoing basis. Some insurers require you to notify them if you start smoking, for example, or if you change occupation, or if you change and move to another country, for example, you might need to notify your insurer. So just check on those couple of things. But it's normally very sort of, it's not too cumbersome normally. And then the last point I added here, Johan, is the point about beneficiaries. We often see cover being put in place with us where there's no beneficiary nominated, which might be the intent of it, but typically you would think that the money is either, there's a beneficiary, a wife or a family behind it that needs to be nominated. Alternatively, as you know, the money will then be paid into the estate, and that could take a bit of time to eventually feed back into the family or to the family. So also something to just take note of. And yeah, that's really my story.
Okay, thanks, Stephen. I'm going to go to Excel now, where I tend to make sense of everything that you've just explained. I think most of my clients are in the same position as me. If you can't visualize it and see the figures, it's hard to remember all the facts. But so I'm going to go straight to insurable interest and what I usually do to ascertain, how much cover a client needs. So first of all, I just want to start off by saying that if you're, for instance, earning 200,000 a month, but your expenditure is only 100, and you have saved, you're on the curve as far as your savings are concerned to retirement age, then you don't necessarily have to, replace the income that you're currently earning. So for me, it comes down to what do you require and what does it cost? So I'm just going to use an example just to play around with some ages and different amounts, just to give people a more or less an idea of what sort of cover is required. So here I've used a 45-year-old individual. Said the date of birth was the 18th of July 1978. I think that's age next birthday. So maybe 44-year-old individual turning 45 with the anticipated retirement age of 65. In other words, another 20 years to save towards retirement. This particular individual has saved up until today about 5.82 million. We're not going to look at the retirement figures. We're only going to look at the life cover amount for today. And then I said the life expectancy, and you can play around with this, is 100. For today's purpose, I'm going to change that to 95. So in other words, another 20 years to go, and then 30 years in retirement. And I'm going to work on a figure of 100,000 after tax that is required. And you will see that I gross it up for tax purposes. Reason being, should something happen to you today, an amount is going to pay out and to your spouse, and that amount, or a trust or whatever, and that amount has to be invested. And there will be tax on the gains on this portfolio. So there will be income tax on everything that is interest of nature, and there will be capital gains tax on everything that is capital of nature. So I'm going to use an individual in this example. For a trust, I should use a slightly higher tax rate. Reason being, if you do not distribute gains in the year that a trust receives it, the trust has to pay the capital gains tax, which is obviously 36%. And not 22. So for today's purposes, let's just assume an individual leaves everything to his or her spouse. And you would concur with me that if you on the top marginal rate of 45% and you use the 40% inclusion rate, your capital gains tax equates to 18%. I've used a slightly higher rate of 22. Reason being, whatever this amount is times 36, in other words, 3 years provision for income, you usually invest in an income strategy that doesn't have any exposure to equities or property. It usually has an exposure to cash and to bonds, which is interest of nature, hence income tax will be payable on that. Very difficult for me to, without knowing what the marginal tax rate is, to take a guess. But I've increased that slightly from a 18 to a 22. So in other words, 100 times 12 adjusted for tax is about 1.5 million per annum that is required in order to give you 100 a month. And then it is pure present value, future value calculation that you do using the resultant rate, which is the difference between your growth rate and your inflation rate. We can go into the detail when we sit one-on-one, and that is over a period of 20 years. And you will then see that that figure below just populates into this box. So you can just keep an eye on this box here. So basically what I'm saying is that if you want to replace 100,000 rands worth of income for the next 20 years, adjusted for inflation, in other words, in real terms, you want to earn 100 a month, then the cover amount that you require is 21.6 million. Now, this is based also on the anticipated growth factor that you think you will get, once the money is paid out and that money is invested. What growth are you going to get on that money? So I've used inflation plus 4 in my calculation here, which I think is conservative. And the point that I want to make here is when that money comes out, and you do not invest it correctly, let's say you have a conservative approach with the money, it would mean that you would have to take more cover. If I make that 10 and 9, you will see that the amount of cover required has increased. So I'm going to leave it at 10 for today, because that is a figure, inflation plus 4 is a figure that I feel very comfortable with. Just show you that 21.6 million rands worth of cover is required. If I now say the person is 10 years older, and I'm going to make that a 1968 model, in other words, 10 years to go to retirement, you can see that the figure has dropped to 13 million that is required. If I change this to say, listen, okay, 100 a month is my expenses, but I haven't saved enough for my retirement. Out of this 100, I still need to save for retirement. Let's call it a 30,000 a month. I'm going to increase that figure to 130. Just keep an eye on column J there. So the 13 is going to go up to, just call it 17 million. So as you can see, it's very much an individual thing that one has to, calculate. So you're more than welcome to contact me, and we can do it on a one-on-one basis. Just always keep in mind that you can't insure, more than what you earn, and we can add provisions in for debt and estate duty. That's also payable. We can add this amount. So this amount that I'm covering here is purely a replacement of income up until retirement age, and any provisions that has to be made for future savings that still has to take place. So what I would like to do now is just to briefly show you on an example that I did for somebody very, very recently. So I'm going to start off and cover the green block, which is what is required. So after taking everything into account, I calculated there's 26.5 million rands worth of cover required. Critical illness, Cashandra, Stephen, you can come in here as to what is a reasonable figure. I've put it down as 1.5. In the past, people used to talk about 1 million. These days, I don't know if 2 million is more appropriate. What are your take on that?
Yeah, from my 2 million is the rule of thumb, but on critical illness, there's really no number, as Stephen said earlier as well. It literally is about affordability.
Okay. Income protector.
Stephen, maybe from your side.
Do you want to add anything to that, Stephen?
No. I think that is normally, it's a difficult one because critical illness benefits, and we'll get to that, I guess, at a later point. Why do you need it? Often the clients have a perception, they have a medical aid, why do they need critical illness? And we'll get into that. There's many reasons why you need to have at least R1 million of critical illness, and probably a sort of a good rule of thumb is around a 1.5, 2 million. If you can afford a little bit more, do it. But at least $1 million, $1.5 million would be my view.
I'm actually going to share my screen this time so that the two of you can also see, what am I covering. Apologies for that. I've just realized that I didn't share it before. Okay, so we're back here at the 1.5 million critical illness. Income protector, I've put down at 100,000 a month, which is pretty much what this client required. And capital disability, a figure of 5 million. So this was what required. When I had a look at what did the person actually have in place, he had individual life cover. There are the figures: 8 million, critical illness 922, income protector only half of what he required, capital disability at 3, and this was the premium that he was paying. He also had group life, and this was the group life cover. So if I add those two together, I got to 11.3 million is what he had in place. So you can see a significant shortfall as far as what is actually required. And that's why I asked you in the beginning to write down these figures for me, your existing cover figures over here, and what you are currently paying for it. Because, I always say, if you buy a 2 million rand car tomorrow, regardless whether you buy it cash or you finance it, you're not going to drive out of the dealership without insuring it, or you're most certainly not going to insure it for 50,000. And the same should be true when insuring your own life. Especially for your beneficiaries and the people that are dependent on you. It's a very, very big risk to only insure you for less than 50% of what is actually required. So I want to call on the people that are employed that have group life cover is to also do this calculation. Do not think that because you have group life, you don't have to consider individual life, whatsoever. One needs to ascertain whether what you've got is actually, sufficient. So long story short, there was an option available to only cover the shortfall. In other words, leave the individual life currently in place. This particular person left the employment of a group life, so we had to take over that cover due to the fact that the continuation option that was available, the cover wasn't comprehensive enough. So Cashandra did a quote for me through Momentum, and this is basically what the status quo came to. For the cover amounts required, it's going to cost about 10,200 a month, and you can see this individual was paying 8,100. So not a very big increase in premium due to the fact that this person got a discount from what Momentum refers to as life returns. We'll cover that in a separate video at a later stage. So he received a 25% discount on his premium, but now he is, sufficiently covered. So I think from my perspective, your investments are fine. I'm looking after that on a daily basis. We've covered whether your will and testament is in place, both locally and offshore. One of the boxes for my clients that are not retired yet that we still need to tick is basically doing this calculation for you, just to ensure that you're adequately covered. So I'm going to quickly run through my record of advice. So I basically said you can't go with the conversion option. It's not adequate cover. I also said that the existing individual life cover was on an age-rated premium. In other words, when I did the calculation and I had a look at what that client was going to pay when he was age 60 and 65, the math gave me the answer that that's not the path that you want to be on. What I like about Momentum and is the fact that I can attach certain premium patterns to life cover, I can have a different premium pattern for critical illness, income protector, and capital disability. And we can discuss that when we meet individually. But that is not a benefit that you can get from most insurers. Also, the cover is not linked to any integrators. In other words, what you see is what you get. You don't have to do X, Y, and Z this year and next year and the year thereafter in order to get, A, B, or C. The other nice thing that Momentum has launched towards the end of last year, they've done away with these smart watches that people put on their kids' wrists and let them run around in the park and cheat the insurance. And they've done away with, you have to go and see a professional person to do a health assessment every year. The only thing that you basically have to do is do a 5-minute screening via their app, the Momentum app, and the app assesses your fitness levels, your health risk, and it basically gives you your premium based on that. So a lot less cumbersome. I think well done, Stephen and Cashandra. I think you guys have done a great job in that regard. And then also from a capital disability perspective, you can put that as an accelerator. In other words, if you do become disabled, that 5 million would pay out, and it will be deducted from the 26.5. And then just the last point there, I said life cover amount and capital disability not to increase automatically annually. This we can also discuss one-on-one. It all depends on how much you've saved to date, and also how much cover you have. The point that I just want to make there is, if you now say this individual age 55 or 54 turning 55, 1 year later, if we make that 23, 24, just keep an eye on that column J again, the 16.9. Okay, now I've screwed it up. Just give me 1 second. Becomes 15.6. So 16.9 becomes 15.6 because this person is now 1 year closer to retirement. Hence the reason, I recommended that we keep that amount flat. We do not increase it, because if you now adjust that figure for inflation, 15.6, unfortunately this sheet is locked. If you add 6% to that, you're going to be pretty close, or 7%, pretty close back to that number again. So hence I usually recommend that the life cover does not necessarily increase. I prefer to do it based on assessment on an annual basis. So yeah, I think from my side that's the only calculations that I wanted to show. So maybe just to recap, videos that we are going to make going forward in conjunction with Stephen and Cashandra, we will be covering income protection, disability cover, and critical illness in more detail. Today's video was pretty much just about life cover. And we'll try and incorporate life returns and what's the impact on that on your premiums when we make these videos, and then we'll make separate videos for key man insurance, buy and sell agreements, and employee benefits. One thing that we can maybe add to that is just to do a basic estate duty calculation, so that you can sleep well, not worrying that that's going to ankle tap whoever you leave behind. Yeah, so I think from my side that's everything. Is there anything else that Stephen, Cashandra, you just want to close off with?
No, I think maybe just if I had to make a closing statement, conceptually it's a fairly straightforward thing, life insurance. The complexity comes into structuring it correctly and making sure you set up yourself for success and certainty, as in most things in life. And I think you need someone to help you with it. So I really advise clients and everybody to speak to someone who can help them structure it properly.
Let me speak to me, Stephen, not speak to someone.
Speak to Jan. Speak to Jan.
Okay.
Yeah.
From your side, Cashandra?
No, it's just the importance because we see on a daily basis where people's wills and their life planning do not tie up together, and they had an intention of the one and it's not executable. And by speaking to you, they make their last wishes executable by a simple plan, putting a simple plan into place.
Yeah, and I think, every time you acquire a new vehicle and there's debt on it, or you have another child or something to that, the status quo changes. So the thing is, the cover that you put in place today is for, everything that's on the table today. As life changes, which it does, your risk profile also changes, and the cover that you require also changes. So it's the same as investments. It's something that you have to continually, have your finger on the pulse to ensure that you have adequate cover. I think the biggest concern for me is the fact that people do not know that they are underinsured. Like I said, with their cars, it's simple. They know the value is 2 million. They must insure it for 2 million or 1 million. But with their own lives, they're unaware of how much they should actually insure it for. And I think there's also a perception, I think if you ask most of my clients for an amount of 26 million rands worth of life cover, 1.5 million rands worth of critical illness, 100,000 rands worth of income protection, and 5 million disability cover, most of them would, in all likelihood, give you a figure much higher than 10,200, as to what that cover will cost. So yeah, I think it's just an exercise that has to be done. It's quite a time-consuming exercise, but it is as important as updating your will. Yeah. So I think we're gonna leave it at that. Thank you very much once again for your time. Look forward to our next video. Cheers, everybody. Have a good day. Bye.